Let's see if this. Yeah. All right. Hold on just a second, and we'll. Okay, I think we're good to go. Give this just a few seconds for YouTube to catch up.
Okay.
Good morning, those on YouTube. So, running amok. I want to know how you answered or solved the puzzle.
It was kind of an up and down sideways process for me. We originally kind of went down a rabbit hole trying to figure out the characters, or thought it may have had a team theme, and then figured out I was making it harder than it really was.
Uh-huh.
And the tipping point for me on that was the other video talking about the stones and the gems, and I
Ah.
kind of yeah,
Yeah.
and I actually looked up Shelley's, like, the meaning of her name,
Mm-hmm.
and it came up with like hillside or meadow or something random like that. And I was like, wait, hillside, and I was like rock something. So I just kind of was like, wait a minute, it's like, and then it just kind of started clicking, and I sat there for about another 3 hours putting things together.
Well,
And
the Shelley was not, as far as the hillside, that wasn't intentional, but I had to come up with some sort of, I needed a couple more letters that were not available in her actual character name. So that's why I said maybe it's Shelley. I don't know, but you had to check the spelling anyway. But that was really off the wall because at that point on that video, checking spelling would be irrelevant. So, like, who the heck cares? But yeah, then a couple of other videos. I mentioned the stones and that kind of stuff. I wanted to get people to the mineralization, the slate. And then once the slate was known, then it would have been relatively easy.
yeah,
Yeah.
and it was I definitely got thrown for some loops by like going outside of that video and looking at other videos.
Uh-huh.
Um, I came up with probably every bit of 5,000 answers that weren't right.
Oh boy.
To the point my wife's like, "You need to get away from that." I was like, "No, I'm going to figure this out."
It's funny.
I was
So
like,
so
it's not going to beat me."
so tell us your previous trading experience. How long have you been on the market studying trading, et cetera, et cetera? From before us.
Yeah, so about 6 years just doing stocks and options.
Okay.
Um, this makes me new to Forex.
Okay.
Um, uh, I've been through uh one, two, probably three gurus,
Mm-hmm.
and I've spent more money going through them than I've actually made.
Mm-hmm.
And it kind of seems like going through them made things worse than what it was if had I just kind of self-studied or
Mm-hmm.
self-taught. Um, but I've yet to find my way or find a good strategy that works for me. Um, and I believe I know why now. So,
What's that reason?
um, your training so far, I've um been able to go through a couple days of the training as well as a weekend session, and seeing how everything is getting put together and the information that's available now. To me, it's almost borderline criminal on what the retail side of the market is doing.
Yeah.
Um, it actually doesn't make me want to trade on the retail side at all.
Yeah,
'Cause
it's yeah, there was somebody that commented on one of my posts yesterday. At first I thought it was like condescending, but in a couple of his comments that he sequenced together, and he said thank you at the end, he said, "Geez," he says, "I just spent the last 25 years and I realized, or he realized he was doing it wrong." And he'd been trading for 25 years, but the market's been intentionally constructed to make it more difficult, make it more opaque, obscure, abstract, but yet it's promoted or allowed that to continue because that's where the banks make more money. It's free for them. Now, the amount of capital that any individual bank generates on retail is relatively little. But they've got to allow the retail brokerage entity to continue because it's those retail brokerage entities that brings them, kind of the constant flow of, customers. And it's not a customer directly for the bank. It's just more activity because the bank is being paid by the broker for a stream, for a feed, and yet if there's restrictions put on this freewheeling, nonsensical level of education in the industry education, rather, well, that's going to put some limitations on the bank's ability to pull money from the broker, right? Very few brokers in the retail space do any sort of a book hedging. Very few, right? Maybe 5%. The rest are all bucket shops. So how do you differentiate between a bucket shop and an a book solution? Really comes down to the quality of service. If the prices are pretty tight, not too tight, if the prices are pretty tight and narrow between the bid and the offer and the commissions are low, then it's more inclined to be a solution that allows you to trade effectively, doesn't interfere with your positions, isn't skewing prices away from you, hurting you, and they're a technological service of connecting you to the market. Right? So on the flip side, you know that you're in a B book solution where they're taking the opposite of your trades. Your risk is their gain is your risk, but then they're interfering with the execution, maybe some slippage on typically not the entry, but the close of the position is where you'd see that. So there's all sorts of stuff that these brokers play games with. And then uh, when the prop funds started to flourish, that was because the capital requirements for a brokerage went up to 25 million in cash with the NFA. Now you've got prop funds flowering like crazy, where it used to be the prominence of the retail brokerage operations, who then went out of business. So their access to the retail customer base came through, or started to go through, the prop fund solution. There is no difference between a prop fund and a brokerage. None. right? The only difference is what they present you is a solution to trade their capital versus using your own leverage or using leverage on your own capital. But they are, in fact, no different, right? So,
And I think coupled with the prop firm's rules and the market's already against you from the start, there's no edge there at all.
no, they make it intentionally difficult. I mean, you think about it. What they present you on their website is they want you to trade their capital, but not one prop firm that I know of, well, except for one, not one prop firm in the world that offers anything more than 10 to 1, 20 to 1 leverage does any sort of risk management. Not one. And it doesn't make a difference if it's through MetaTrader 4 and all of those solutions that some of them have gone away of recent years, or within the last year, technically 2 years. Some of them have gone away. They've gone to MatchTrader. MatchTrader is a little bit of a wholesale venue, but I had discussions with MatchTrader just a month ago. And matter of fact, that discussion continued just this last week, right after Christmas, because my objective is, if there's any sort of solution that can be obtained or even built that offers a book, risk management and, clearing of trades while still providing somebody, some leverage and some transparency, and, by all means, I'm gonna fight for that. But MatchTrader right now, out of all their prop funds that they serve prices to, that is all they are serving is the price feed. None of their customers do any risk management right now. In other words, a customer trades, it goes right into the books of the prop fund. The prop fund never takes any of their positions and lays them off to the open market. Doesn't even place the trades with MatchTrade. They only keep them for themselves, which is a B-book solution. Same thing for DXTrade. DXTrade, except for one that I know, and that's the concept trading. They offer such a low leverage solution. Effectively, your challenge fee is about 10% of your equity, which is nothing different than what you could obtain going to just about any brokerage in the world, no matter where you are. You could obtain better leverage. But what prop funds do, disregard for a moment the leverage and the solution in total, but what prop funds do is require you to stay within a set of rules. I'm not saying that those rules are good. They're all garbage, with the exception of TCT, and I'm not soliciting them. I'm just suggesting that they have a solution where they take the opposite of the trade and they actually book that with a broker, and they use regulated brokers, and which MatchTrade is not, but they do use regulated broker through, I think it's Blueberry Markets through DXTrade. Now, I don't know DXTrade. I know of the platform, but I've never traded on it because it's relatively new for trading platforms. I've been around, the markets long enough. They started Dev Experts, which is their website production company. They started as a solution to build websites for brokers and some plugins, but not trading platforms. So DXTrade is the platform that they built over the last, I don't know how many years, but I've heard good and a lot of bad about it. All right. So who knows? And that's kind of why I asked on Itrade.social the other day if anybody was currently using TCT, or effectively I wanted to know what DX Trade was about in terms of its trading functionality, and then I wanted to know what TCT currently offered in terms of the spread and commissions, because it's the spread and commissions that are probably, from a granular view, the most consistent factor in traders blowing accounts. It's not necessarily just the losses, but it's the commission and the spread when customers are over trading and consistently just chewing away at their capital base. So, all right. So, sorry, I went off on a little bit of a tangent. I guess typical morning digression. So let's get back. So you traded equities and options. A first time for you into FX. What was your trading confidence before you jumped on board in a percentage?
Probably at an all-time low, probably like 30 or 40. Like I had just lost faith in everything that I was doing or seeing.
Okay.
But since being on this side, I'm getting very high. I'm probably at least an 80% right now.
That's a good jump for a few days.
Yes. Well,
Yeah.
I've been following you for a while and
Mm-hmm.
kind of catching on and jumping in streams when you have them, watching a lot of videos. And it kind of all started to click.
Okay.
Um,
Well, let's
but
see if we can pull the pieces together and let them fit. So, in comparison to what you knew before and what you know now, what's causing the exchange rates to move? Is that a different perspective? And I know foreign exchange is a little bit new to you, but is the perspective on the individual candles different now?
yeah, actually, I don't even really put a lot of weight into the candles anymore at all.
Okay.
I'm more paying attention to the bottom of the screen on what the sediment is
Mm-hmm.
versus the values of
Okay.
the euro, and try to correlate that with what I'm seeing at
Mm-hmm.
the top, but I'm not going from the top to the bottom.
Okay.
Um,
So,
because the price, from what I've read, is move like the candles are your last step of the result of everything else.
yes. So, do prices move? How do I ask this without giving away the answer? Uh, do prices move as aggression hits them? So, let me put two different conditions here. Prices move as aggression hits them, or prices move in a vacuum?
Um, it's more of the vacuum.
Mm-hmm. Okay. That's probably the most important condition that traders could ever realize, right? Because there is no change in price unless there's a vacuum that exists. So once the vacuum exists, then the aggression actually hits the market. So the vacuum is the differential between value and price, right? And this differential creates the sentiment. Okay, so sentiment is just that differential between the value and the price. So it's pushing that price or pushing the value, which causes then volume aggression to hit that opportunity. So the vacuum has to exist. The volume then hits with aggression, and that causes the differential to get consumed, to be consumed. So it kind of gets chewed away, and there's nothing, there's nothing left. And when I'm going to go off to the left here and draw, well, I can just use the candles they're on the chart, Nick. All right. So if sentiments move to the upside, and then prices continue, and as prices continue, if the sentiment no longer exists, and this is an important part, if the opportunity in this yellow zone no longer exists, as the prices continue to move, the sentiment will naturally dissipate. So what has to happen in order to get this price to continue, right? What has to happen? It's a trivia question, another puzzle. You have to have more aggression that hits somewhere in here. It's got to be more than what's already hitting through here in volume. Because if we don't have more aggression, the opportunity that's presented itself will eventually dissipate. But it's got to constantly have more aggression in there for this price to continue. Right? Because buyers and sellers, are chewing up, or the buyers at this point are chewing up that available free yield. It's being eaten alive, right? And if that free yield doesn't continue, well, then the price is going to fade away. It's going to stall because the opportunity is, in fact, going away. So what has to happen in order for this price to continue higher? Well, you've got to have some sort of economic change. You've got to have some sort of condition that would create a stronger opportunity for sentiment to continue higher and widen the differential between sentiment and price. And when that happens, well, price can continue. So if sentiment didn't change and prices started approaching it, right, then you're coming into that zone where it's ready to reverse itself, right? But the most important component, going back to it, is that prices move as a result of a vacuum. After that vacuum exists, the volume's aggression hits the market, and it continues until the differential is no longer present. It's that easy. So how do we put together the pieces of the puzzle in order to identify the conditions that would give us statistically reliable opportunities, right? Recognizing that foreign exchange is by far the largest and the most efficient market that there is. So how do we put together the pieces of the puzzle, knowing that the market has some structure, right? The movement of exchange rates on those candles always follows that perceived value. But how do we put together a structure that we can trade on, identifying the how, the why, the when of exchange rate directional changes, and then be consistent by pinpointing turns or extensions higher, or turns and the extension higher, right? So we use the data points of the indexes and of sentiment, and whether we're looking at the 1 or the 5, obviously you've gone through the course material enough, and probably heard my discussions on, the one is, or the lower time frames, not necessarily just the one, but the lower time frames is where all trends start and finish. It's just the middle ground of the larger candles, those higher time frames that just fill in the middle ground. But if you break down the 1 hour chart, eventually you're going to see maybe a 5 minute interval or a 1 minute interval that creates constant higher lows, higher highs in that interval. So we've got to, break it down and give ourselves some statistical certainty or reliability, and then make sure that we're following the data points that drive it. And in following the data points that everybody has access to, it's just retail traders or the gurus that are out there don't understand it themselves, and they're pitching this abstract nonsense, again, on the most efficient market in the world. So let's break down the hierarchy and get you someplace where you can put some focus to it over the next few days, and we'll come back and do another session with you to see what your progress is, and everybody can kind of participate in the progress along the way. So probably the best place to go is kind of that simple format that we typically do, with the crossing of the indexes and then some realization on sentiment. All right, so if we're looking at the indexes here, and I'm gonna block out the indexes themselves and just focus on sentiment for a moment.
Okay.
Because sentiment is where it's all at anyway. So if we start off here, you've got this slight little drifty range, and you want to see something different taking place. But in terms of sentiment's got kind of that correlated movement, and then it's got this breach higher. Where does that breach higher come from? In what you know so far, what you've learned so far, where does that breach higher come from?
That would be the value difference between the euro and the USD.
Okay, but where does, so let's go back and make sure we're not, and this is the first time I've asked you this question. So by default, people will say that it comes from the differential between them, but where does that come from? I want to get to the source of the data.
That one kind of got me stuck by running off the sediment. I don't have a great answer for that.
Let me give you the answer. All of those.
Oh, the overall.
All of them. Well, at least all the major permutations, right? Because the major currencies, the major 8, euro, dollar, sterling, yen, CAD, Swiss, New Zealand, Aussie, I don't think I missed any. Those are 98% of the overall market. Remember, we can't trade a slice of apple pie. We've got to trade the whole pie, because that way we're covering the entire market. All right, and if we're just looking at the euro dollar, we've already lost. Right? So this data on sentiment comes from all pair. Right? So as it comes from all pair, it goes into the indexes initially. Right? And then the indexes are taking the data from all the pair and telling us what the euro needs to be doing. Make sense?
Yep.
Okay, so now that we know that sentiment is never wrong with a reliability of upwards of that 98%, right? It just does what it's supposed to do. And when that differential is greater than the cost of doing business, so let's discuss that really quick. When that differential is greater than the cost, that is precisely what triggers banks. So now you know you can look at the chart and in 5 seconds recognize whether it's a buying condition or a selling condition. And I'm talking right on this candle. You don't have to guess what's going on. Right? Now, every candle is going to have noise in it. 15% of the tops, 15% of the bottoms. Every candle is going to have about 30% noise total. Right? 15% at the top and the bottom each. So the breach of this move lower that it's kind of drifting, we get to here. This is telling us there's a breach in sentiment higher, and that happens just before, and I'm going to put a vertical line there so we can see the timing of it. That happens just before the price actually breaches and moves to a little bit of a higher high on the candle. You see that, right?
Mm-hmm.
Okay, so sentiment always moves first. Always. Again, that's what's creating the vacuum or the void between value and price. So when that is greater than that differential, again, is greater than the cost of doing business, that triggers the banks to become aggressive. They see opportunity. They're trading for free yield. What is the cost? Well, retail pays between $6 and $7 per lot. And a lot is 100K. Wholesale pays between 30 and let's say 70 cents on the high end equivalent. Right? So you've got relatively little in comparison. So $7 between $3 and $7 per million, whereas retail is paying $6 to $7 per 100,000. So a significant disparity between what retail pays and what wholesale pays. But if we go back to the cost and the differential, all it's got to be is 1/10 of a pip. And that is greater than the cost of doing business. So if you see a differential that's a pip and a half, that's nothing but free yield. Right? If you see a differential at 3/10 of a pip, that's not quite enough to cover the risk of spread, but it's enough to cover the cost. So somewhere around the half of a pip mark is where I like to see the differential, because I know that covers the cost and the risk. So how do you know that? And what does that do if we're looking at the candles? Let me erase this and get ready to draw another schematic. All right, so what does that do if we're at a half of a pip in minimum differential? I can tell you institutional venues are priced at about a half of a pip. But what's more important, and I use this nomenclature all the time, is a buffer. The buffer is a half of a pip. The differential, I want to be at a half of a pip. Because at least at that point, I know that if the differential is a half of a pip, it's doing exactly the same thing that an individual candle would be doing on a move to the upside, seeing a low bid of 32, and then seeing a candle drop and recognizing that now sellers think the price is worth less than the 32 because the sellers are at a 31.8. Maybe the bid is at a 31.5. But as long as I'm using that buffer of a half of a pip, now I've only used 3/10 here, but that's okay too. As long as I see the asking price, which is important, the asking price is lower than that prior low bid because the charting is done on the bid. So as long as I see the asking price below the 32, well, now what I've done is I've effectively broken the buffer. And now it's not just going into this candle over here and seeing the high bid, but now the bid is higher than that by an amount greater than the buffer, which means the buyers that were on this candle, let me clean some of this up. The buyers that were on this candle, when the bid was here, the buyers were here, and now the buyers think the price is worth more than what the sellers thought it was down here. That's a clear shift in direction. But that's what that buffer allows, not just on the changes in direction, but also on that differential. So if you see the differential at 2 pips, there's opportunity there. Right? If you see it at a quarter of a pip, it's marginal. Right? And that's where the market comes back over to here, where it starts to taper away. All right, so we got off on a good bit of granular digression. Let's go back over to sentiment without seeing the indexes for a few minutes. Oop. And let's look at the break. So sentiment and price need to react. And when sentiment and price react, it becomes something valid. But recognizing that there is a structure to the combination and recognizing that sentiment is reactive, right? Sentiment moving to the upside here, that gives, this is the high of sentiment. The follow through is just noise. 15% of every candle has noise at the top and the bottom. And that includes moves. Because if this were a 5-minute candle, it would have 15% noise at the top and 15% noise at the bottom. Right? Where sentiment failed to find a new low, but price drifted to a new low. Sentiment failed to find a new top after or before price. Sentiment reached the top here, price continued without sentiment. It wasn't going to last long because it was just tapering away. Right? But sentiment reaching a high and then pulled back in through here. Where did sentiment reach its low? Well, somewhere right over here. And then price drifted. So in order to see a clear change in direction, it's not just sentiment that has to move. It has to be price. So this is what I talk about in bid-ask bounce. right? Bid-ask bounce is the combination of the two. We're not trading on the lagging component of price and candles. We're trading on the data that causes them. And you can clearly see that. Here's the breach higher. Here's its failure. Here's the failure of sentiment. And yet the candles drift until they pull back. And they don't have to pull back all that much. But what we need to realize or maintain is that connection between how sentiment drives the price responds, and gives a pullback. So there's two price levels. Sentiment moves, it becomes reactive, and as a reaction to sentiment moving higher, it starts to pull back, and then it moves lower. It's trying to find balance. It finds balance and goes back into a positive state right there in this candle. But when it goes back into a positive state, this is the price low there. Well, and this was the price low in here. So then we're looking for the next low of sentiment where it's below the parity line, right? There's a little bit of one right there. That's probably this candle. But you see, everything's got structure. All right, so you've got a low, you have a higher low, and then this is a higher low. But sentiment doesn't breach this low. Let's call this low number 2. Low number 1, low number 2. In low number 3, it doesn't breach low 2. Right? So this becomes just a pullback. As granular, as microscopic as it is, it becomes a pullback with what? Support. Continued support. So then the market jumps a good bit. It fails to go lower. It jumps as a reaction to it. Sentiment certainly higher. This is an example where where I was looking for a continuation here. It actually shows that continuation right there. This is what it looks like. Here's sentiment breaching above its prior high in continuation of pressure or vacuum on that price. And prices follow because it's seeing an extended or just a strengthened opportunity, which then causes more volume of aggression. But then we look at low number 3. Here's low 3. And then we look at low 4 on sentiment, and that's up here again on price with low 4 on price. Then somewhere over here, sentiment comes to the downside in 5. But that's right here on price. So sequentially, between 1, 2, 3, 4, and 5 on prices, it's still working its way higher. The caution of sentiment breaking below still requires the price. Now, sentiment is that leading factor. Prices jump strongly, sentiment is going to find balance and lead it back to the downside to some level. So as long as you recognize sentiment is leading, prices are following, you don't get a change in direction until you have a breach of both sentiment and price. That happens when there is a differential greater than the cost of doing business. Well, then you have a pullback in 5 without the breach. It's just a pullback. Now, the 1 minute is the interval we're on. The 5 minute still maintains bullish net direction. and then it goes back into a drift. So it leaves behind a low in 5 and goes back into a positive state. Right? So here starts breaching or starts pushing higher, and let's call this A for a high on sentiment. Well, then it breaches that buffer and starts going higher again. Now, from here on out, it's a pretty constant drift. And it's a pretty constant drift on sentiment until we get to here. But let's look up. We can see that slight little pullback. And then it tries to go higher. It fails. And then it moves lower. So somewhere in here, there's a break of a half of a pip where sellers agree that the price is worth less than what the buyers thought it was worth on that prior bid higher. And that's right there. Obvious. It sticks out like a sore thumb. But then this becomes the combination, and it's not right away, but we've got a market that's moving lower on sentiment, and I'm going to change to red here. And I'll use a little bit of a thicker pen. The market that's changing lower on sentiment lower, price range bound, sentiment lower, price sentiment lower, lower, lower through there, and then price finally breaches and clears out not just 5, also 6 on that low over here. Or no, that would be 7, sorry. Not just 6, because 6 is down over here. But 7 is that next low that has the breach of sentiment and the breach of price. Right. Let's not ignore the fact that most traders, including institutions, they have to trade on price. So price breaking a prior low causes the banks to go from this zone where they are market making to this zone right here where they are aggressive in selling. And here's a statistic that you've probably heard me talk about before. 95% of bank turnover on a daily basis is aggressive. Only 5% is market making. But if we go back to the value proposition, if there's no differential in value, the price can't move. So in all of this range, specifically through here, there's no difference in value. There might be a little bit of noise in sentiment in pockets, but if we go back to the indexes, that is precisely where it's gone range bound in through here, and it can't go anywhere outside of that range until it starts to see more sentiment, more of a differential. But it's gone into this range as it pulls back, and now it needs to see a break outside of that range, and it does that here. And it's got to have sentiment to do that. So where does sentiment give that push to the downside? Somewhere in between the open of that candle and the break lower. You can see that sentiment reached a high. Let me go back to yellow. Sorry. Sentiment reached a high, sentiment reached a high, sentiment reached a high, it's reached a high right there, and every one of those look, every one of those granular cookies of aggression, was pushing to the downside, with the exception of this one. So you've got this, you've got this, you've got that, you've got this. So reading sentiment for that next bit of pressure, well, it only gave you about 8 to 10 minutes of resistance, 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 and then the breakthrough. Here's that first resistance. Well, here's that previous low right there. If I can go up vertical from that. So that's the low. And then you've got this low. And then you've got this low. And then you've got this low in through here. And then this low breaks all of those and becomes that aggressive. It's a drift, but it breaks outside of that market making range and becomes an aggressive sell. And not even really aggressive, but it's outside of that range, which is where banks trade 95% of their volume. It's only 5% in here. They're jockeying, but they're not trading a whole lot of volume. This is heavy aggression. This is heavy aggression. This is heavy aggression. This is low aggression, low aggression. There's got to be a differential for it. So I think that's pretty good. That's pretty good for a start. What are your thoughts on this?
It's a lot of what I've seen so far. I think that day 2 that I was on, I actually got to watch you trade. I think it was for like an hour and a half. So that really started putting the pieces together for me.
Yeah.
This is kind of like another solidifying what I've already learned, I think, besides some of the terminology.
Well, it's different for most. It's different for most. And 99%, I'll tell you, you know more about how the market functions, and you've been in at it, following me for a while, but you've kind of been submerged into it for 4 days now, 3-4 days.
Right.
But 99% of traders never see this level of granularity. They don't understand it. So,
and to give you a fun fact, my wife walked in the office while I was watching it, and I was like, "Watch this." I was like, "Tell me when you think this is going to move." Within seconds, she was able to point out the entries and exits, and she knows absolutely nothing about trading.
Yeah, I can't say that I haven't been blamed for spouses arguing about time at the screen before. Yeah, but it becomes fun at that point. It becomes fun because it's no longer, kind of that abstract nature of how do you determine a direction when you're just looking at the candles, and you can't. You can't, because you don't know with any sort of resiliency what's causing those candles. So this is no different really than what market makers are going to utilize in determining what the next exchange rate should be when they're making their price streams. But they just use an automated fashion to say, all right, well, we should be bidding higher. Well, now you can look at sentiment and recognize where the price is going to be bidding higher or even lower. So inside, kind of while we're in like trading room sessions, and if I'm in a position trading, I'll talk about the bids and offers, because that's where I see the market react to the changes in sentiment. So if I say, and I use 32 because it's a favorite number, but if it's 32 bid, 31.8, 32, 31.8, and sentiment starts to drop, well, then if I see a 31.7 or 31.6 on an offer price, Well, now it's gone from this range bound bid 31.8, 32, 31.8, 32 to aggressive selling because it's just following that directional move of what sentiment is causing on the next injection of aggression. So that's enough for one day. Confidence still 80%, 85% or so.
Oh, easily.
Okay.
This just takes the stress of watching candles and charts away, where this gives you a ton more confidence and believing in your trade you're about to put in there.
Yeah. Yeah. So we're going to come back, and I believe we're going to do a trading room session at 9. And that'll be on Zoom. So for those who are not, and I think everybody is, but for those who are on YouTube that are not in Itrade.social, in order to get into the trading room session, just register on Itrade.social, and then running amok. We'll catch up with you on the flip side. Hold on, and we'll have a little bit more of a discussion. But for on YouTube, catch everybody a little bit later.